Informed by their experiences of capital losses in the tech bust or the more recent global financial crisis, some advisors believe that diversification failed them when they needed it most. My guests today have written a book which makes a case for adaptive asset allocation as a more effective way to diversify the challenging market conditions that we experience today. Hello, I'm Sean Wurzbach, Global Head of Financial Advisor Channel at S&P Dow Jones. Joining me today are ReSolve Asset Management's CEO, Adam Butler, ReSolve's President, Michael Philbrick, and Rodrigo Gordillo. He's the Managing Partner at ReSolve. Welcome, gentlemen, and thanks for being with us today.
Thanks for having us.
Pleasure to be here.
So, Adam, what's the central premise of your book, Adaptive Asset Allocation?
Well, the main theme is that there are three things that investors should take away. Number one, investors should recognize that they're vulnerable to a wide variety of cognitive biases that, in aggregate, undermine their ability to have long-term success in markets. Number two, they should realize that taking a systematic approach, such as indexing, short circuits a lot of those cognitive biases and really increases their chances of long-term success. And three, that asset allocation dominates long-term portfolio outcomes, and so they should put the vast majority of the effort when they're thinking about portfolio construction on the asset allocation and think long and hard about whether or not they should take active bets in the individual security space.
So I think your book does a pretty nice job of taking some pretty sophisticated concepts and making them approachable to any reader out there. But one of the things you have to be making the case that an asset allocation like 60/40 is flawed. Otherwise, you wouldn't have to go to an adaptive model. So what's wrong with 60/40?
Well, 60/40 has been a really big winner over especially the last 30 years as we've experienced a very long period of declining and benign inflation, a large series of positive growth shocks, and fairly abundant liquidity conditions. But people have to realize that the future may not look like the recent past in those regards. We may go through periods of high inflation or deflation, negative growth shocks, negative liquidity shocks. So you should have assets in the portfolio that can thrive in those types of markets as well, when stocks and bonds are unlikely to do well. And secondly, 60/40, although it's 60% of the capital in stocks and 40% of the bonds, because stocks are so much more volatile than bonds, stocks end up representing about 90% of total portfolio risk. So in fact, bonds, even though they do have diversification benefit, are able to impose those benefits only in a very marginal sense. They're not very beneficial.
Right.
So, investors need to think more broadly about their asset allocation in order to better balance risk.
So, Mike, I'm reading along in the book, and at this point, I'm expecting you to make kind of a prescriptive, here's what we do adaptively, or here's what we do dynamically, and you throw this left hook at me saying, all we know is nothing. So what do you mean by that, and what's the power of that statement within the book?
Well, at the core of that is it's really hard to forecast the future reliably. And I know, you go to your tarot card reader and that's true, and then we go into financial services and we all of a sudden think there's these gurus. So it's hard, but investors tend to behave as though they can predict the future with precision. Even in our most reliable indicators, we're talking about 53% as the edge. It's a probabilistic thinking, and this is not necessarily natural to human beings.
Right, and you're using index data throughout to show how asset classes perform, but you make the case that you're not likely to achieve the average. Like what was some of the power of using index data to look at different asset classes and look at the regimes?
Well, the nice thing about the index data is it exists, and if we come back to having that only a small edge, we have to think about diversification as a way in which to protect ourselves, because we are going to be wrong 47% of the time. So we need all the data, and the index data provides that for us over very long periods of time and over many, many different regimes.
Right. So Adam, you've got the value of the index data in communicating that asset classes can perform in strange ways over time. Does it give you power from an investability standpoint as well to use index-based approaches, at least in some of the things that you do?
Oh, absolutely. Our models require that we have some estimates for the different asset risks, their volatilities, their downside risk, their correlations, so their relationship and how they move against one another. And in some of our solutions, an expected return, which we derive through factor exposures, right? And so we use the direct measures of ETF returns that are tracking indexes in order to derive these estimates.
Right. Rodrigo, within the book, you're making the case that an effective focus is to try to increase the probability for the advisor that they'll achieve the financial goal of their client. And one of the things that you use to try to make the case of how difficult that can be is sequence of returns risk. Can you talk us through that a little bit in terms of what's the case the book is trying to make there?
Sure, and I think that when you look at a long-term buy and hold investor, they're willing and prepared to take periods of subpar performance in order to achieve something close to long-term averages. The problem with that is that, and what few people understand, is that those subpar performance periods can be much longer than what they can expect.
Okay.
In the book, we look at the Dow Jones. From 1966 to 1997, it was an average return of 8%. But they were divided in two periods. From 82 to 97, you're looking at 16% annualized returns. And from 66 to 82, you're looking at negative returns with a lot of volatility. Right? So the investor who retired near the biggest bull market run in 82, had a phenomenal performance. They would have had a phenomenal retirement and left a huge estate to their heirs. Versus the other individual who retired in the 60s, who would have lost money by 7 years, right? So the key, I guess the takeaway is that, you don't want to leave retirement to luck necessarily, and the book addresses it. We actually wrote the book specifically for that. When you go global and you are thoughtful about diversification, you minimize that luck factor quite a bit.
Right. So Mike, related to that, a very complicated problem that advisors face is this idea of withdrawal, or the income portion when the client actually reaches retirement. And in the past, advisors were able to rely on rules of thumb, like, okay, 4%, as long as I've reached the capital goal, if I only draw 4%, I'm going to be okay. And your book makes the strong case that you can't rely on that. What are you prescribing instead? What are some of the insights of the book when you're talking about withdrawal rates?
Right, so when you talk about withdrawal rates, the 4% rule from Bengen that was established in a period of 26 to 76, where that's not the reality we live in today. We have a lot of global debt out there that yields less than 1%. So it doesn't apply. So now what do? Okay, well, we know that the withdrawal rates are very sensitive to the volatility of the underlying portfolio. So we must prioritize not only returns, but also managing the volatility of the portfolio. How do we do that? Well, Peter Bernstein, said diversification is a recognition that we don't know the future. Right? So first thing is, let's diversify, and truly diversify, not just U.S. stocks and bonds, not even just global stocks and bonds, but real estate, commodities, gold, all of those assets. And let's thoughtfully put together a portfolio that's diversified, and then let's let that portfolio be informed by factors like momentum, factors with 200 years of history.
Makes a lot of sense. And Adam, just to try to wrap this up a little bit, you're stating in the book that the fundamental risk for an advisor is that they're not achieving their client's financial goals. How does adaptive asset allocation help to mitigate that risk that they don't meet those goals?
So there are four pretty critical advantages, we think, that make adaptive asset allocation compelling. The first one is that because it's long only, we're taking advantage of this historical precedent where major global asset classes do deliver positive long-term returns. So we've got this tailwind of long-term global asset class exposure from being long only. The second is that we recognize that the future may not look like the past. And so we want to have asset classes in the portfolio that can thrive in periods of very high or very negative inflation, negative growth shocks, liquidity shocks, these types of periods. And so you want to diversify across a wider variety of asset classes than you see in a traditional portfolio. The third is that rather than trying to make long-term projections about asset class returns, risks, and correlations, and then create a strategic asset allocation around that, we'd rather observe the contemporaneous risk and correlations and use factor bets, as Mike said, in order to inform how we might emphasize different securities in the portfolio. And do that in a dynamic way so that the portfolio constituents change over time and keep risk constant, rather than holding the portfolio constituents constant and letting risk go up and down substantially.
Right.
And fourth, Just touching again on this whole idea of factor investing, we believe strongly in Samuelson's dictum, which states that markets are micro efficient at the security level, but macro inefficient at the broad asset class level. And so we systematically take advantage of the market's behavioral and structural errors that allow major asset classes to drift very far from equilibrium. And we systematically harvest returns from those errors using this very long-term momentum factor. So for those 4 reasons, we think this adaptive asset allocation methodology is a compelling case as a core portfolio allocation.
Well, gentlemen, thank you very much for sharing some of the insights from your book. I realize we've only scratched the surface. You've taken a lot of interesting and sophisticated concepts, but do appreciate what you shared today and commend people to read the book.
Thanks very much, John.
It's wonderful being here.
For those of you that'd like to learn more about how indexing works for financial advisors, please visit our website. That's www.spdgi.com. Thanks and have a great day.